take the price and it changes from one to the other, from one transaction to the next, and it's gone up. Even if it's gone up a penny, it's called an uptick. And if it's gone down, it's called a downtick. And that's per transaction on a single individual company stock. Money flow is a type of market analysis that analyzes ticks. If you are buying stock on an uptick, it's a positive money flow because the money is going up. If you're buying stock on a downtick, it's a negative money flow because the money is going down. Do what? We talked about the change and looking at the high and the low and the close and doing simple moving averages off of the close to kind of see trends in stock. They also do something called a daily money flow, is another way to look at trends in stock. They take the high, the low, and the close. Take the average of those three numbers, so add together the high, the low, and the close divided by 3. They multiply that by the number of trades there were for that stock. And then they compare that day by day by day. And that tells you if that number is going up, you have a positive money flow because it's increasing. If that number is going down, you have your negative money flow. So this is one of the more kind of a smoothing technique that gets used. Okay. Oops, that's not what I meant to do. You guys don't need my to-do list. We can also look at the net money flow, which is different than the daily money flow. With the net money flow, you look at how many transactions are occurring on an uptick versus a downtick. If more shares are being bought on an uptick, you have a positive money flow. And if more are bought on a downtick, you have a negative money flow. Basically, this is saying that people are more willing to pay higher prices for the stock, which bodes well. Okay, your portfolio is all of the stock you own, and that can be like one company or a bunch of companies. Your trade is occurring when stock is bought or sold. Okay, a rounded lot is when you buy shares in multiples of 100. And an odd lot is any share that is in a group of less than 100. So if I buy 70 shares, I'm buying an odd lot. If I buy 200 shares, I'm buying 2 rounded lots. If I buy 356 shares, I'm buying 3 rounded lots and 1 odd lot. Does that make sense? All right. You have not actually earned money on stock as far as gains or losses until you sell it. Your stock is increasing in value, and so your portfolio might be gaining value, but you didn't actually earn the money unless you sell the stock, because it's just stock. You can't like spend it. Does that make sense? So it might have your portfolio will have a value, but until you actually sell the stock, that's not like your cash. If you sell the stock for a higher price than you bought it for, you have a capital gain, a gross capital gain. If you sell the stock for less than you bought it for, you have a loss. And you'd think, well, why would you do that? Sometimes situations occur where you have to sell the stock, and then you might have a loss because maybe it's better to take the loss and have that cash on hand than some other options. Or maybe you feel like it's just going to keep going down and down and down and down and down, and so you want to get out while you can and not lose even more money. Okay. So to figure that out, we just say, okay, she purchased the stock for $7,241. She sells the stock for $9,219. And so you take the sell price and you subtract the bought price. And that gives you your gain or loss. If it's positive, it's a gain. If it's negative, it's a loss. So she had a gain of $1,978. Not given the total amount that the purchase was, you're given the individual shares. So we have 300 shares that were bought at $34.87 and sold at $41. So first we have to find out how much the total transaction was for each, the buying and the selling. Okay, so I take the 34.87 and multiply it by the 300 shares. So they cost 10,461. And then I do 41 times 300, and they were sold for 12,300. Then I subtract the two numbers, and I have a capital gain of 1839. Okay, to express our capital gain as a percent of the original purchase price, we're going to do the sell price minus the purchase divided by the purchase. That'll give us our percent capital gain or loss. So if we sell it for $6,100 and we bought it for $34.50, and we divide that out, hold on, skip this step on my paper. And it keeps going. Bless you. Unless you're told otherwise, or we're already told, round to the nearest tenth of a percent, so we're going to round to this 8, so 76.8%. All right, if you're talking, even though I can go online right now and go to E-Trade or any number of other sites and click a few buttons and buy and sell stock without talking to an actual person, that transaction is going through a stockbroker. You have to be licensed to buy and sell stock. As an individual, I'm not licensed, so even though I go on the computer to do it, I'm not the one doing the actual transaction. I'm sending a command to someone else to do the transaction that is licensed to do so. Okay, there is a fee charged for that, and that's called the broker fee. And broker fees can vary based on a number of conditions. You can either be charged a percent of your overall trade. You can be charged a flat fee for the entire trade, no matter how much it is. You could be charged a combination of the two, like a flat fee plus a percent. Sometimes the percent changes based on the amount of money for the transaction. The lower the transaction, maybe the higher the percent. So it just depends on what company you're going through. A commission is what is called when they take a percentage of the total stock value. That's called a commission. Discount brokers charge a lot less for fees, but they don't give you any advice. You call them up or you go on the computer and you say, I want you to sell 20,000 shares of Microsoft. And they go, okay, and then they just sell it. They don't tell you, oh, yeah, that's a bad idea. Microsoft just came out with this new platform and they're going to skyrocket. You know, they don't give you any advice. They listen to what you say. Financial planners are the people that give you advice. They also charge more money. Also, financial planners can operate two ways. One is they can give you advice and talk to you about things, and you can say, yes, do this, or no, don't do that, or here, do whatever. And other ones that you just say, here's some money, go with it, and then they'll make all the decisions for you. So it depends on what level of play you want to have in the market. Oh, no, that's not. if you're selling at the market, that's when you call up your broker and you say, or buying or selling, you want to say, I want to buy Starbucks Corporation at the market. They are going to sit around and watch Starbucks at that point and watch the price fluctuations, and then they're going to buy it at the best price. So they're going to try to buy it when it's at the lowest price for that day. They're going to try to guesstimate when that is. Or they might try to sell it. If you're trying to sell it, they'll try to sell it when it hits the day's high. So you want to try to get the best price. If you call them in with a limit order, that may not happen that same day, but you might say, I want you to sell whatever stock as soon as it hits $50. So they sit there and they watch it, and then as soon as it hits $50, they sell it. Or you tell them you want to buy it when it hits $20 or something. They sit there and watch it, and as soon as it hits 20, that's when they buy it. Your net proceeds are the profits that you made, so your capital gain minus the broker fees. When we look at this, we have two trades through an online discount broker, WeTrade. WeTrade charges a fee of $12 per trade. Okay, so his first purchase was for $3,456. His second purchase was for $2,000. How much did he spend? Okay, this is a flat rate per trade. So we have two trades at $12 each, so that's $24 in fees. 24, not 25. Okay. We add all that together, and that's how much he has to spend today. Adriana purchased $7,000 worth of stock from a broker at Tensor Brokerage, and the current value of her portfolio is $11,567. As I was saying, some places charge different percentages and fees based on your portfolio or based on the stock transactions. These charge more money if you have less money in there. So if you have less than $250,000, it's $15 per trade. If you have more than $250,000, it's $12 per trade. She used a broker. So she's not an online or an automated. She's in this category here, trades using a broker. She's also under $250,000, so she's paying a commission of 0.5% plus the online fee. So she bought $7,000 worth of stock. She has to pay her 0.5% commission. Well, I can't multiply this percent until I turn it into a decimal. So I move 2 this way. So it's 0.005, which gives me $35. So that's the commission. But we also have a $15 online fee. So her total fees are $50. In order to calculate our net proceeds, we're going to take, we're going to do the purchase fees. Hold on. Let me rewrite that. We're going to take the total sale minus the purchase price minus the purchase fees and minus the sales fees. And that gives you the net proceeds. Okay, so you have to take out both sets of fees because you've paid that money, and also how much you bought the stock for. So When she purchased the stock, she paid a 1% fee. So that's times 0.01. And that gives me 235.10. And this is the purchase fee. Okay. When she sells the stock, she uses a discount broker. So her sale fee is $21. It's a flat rate. So what I'm going to do is I'm going to take that total sale minus the purchase price minus the purchase fee minus the sale fee. So I'm going to do that on the calculator real quick. 27,300 minus 23,510 minus 235.10 minus 21. These are the net proceeds. So this is how much money you actually made because you've spent all of this.